Ken Shinoda kicks us off to the close, portfolio manager over at DoubleLine Capital. And Ken, I really thought that comment kind of encapsulated the bind that the Fed is in right now. They obviously are looking at a labor market that, in their view, at least if you read in between the lines, probably a tad weaker than what it was, but also looking at an inflation picture that is now let's just call it completely uncertain.
Poor Powell, he was in a good spot. He thought he would ride out into the sunset, inflation coming down, and then oil spikes $30. And yeah, the labor market was weakening, and they thought they would be able to cut, but with the spike in energy prices, it just doesn't seem like they could cut this year. The probability to cut last night was one cut at the end of the year, and that's dropped below one cut. So it seems like unless we get a resolution in the Middle East, that the Fed's going to be on hold throughout the year.
And it gets to this idea, and Powell seemed to be very cautious about, certainly did not use the word transitory, seemed to dance around even the idea that the Fed was discussing that. But it seemed like for a while, the market, Ken, was kind of viewing this energy shock, if you will, if we want to call it that, as transitory. And the idea that they seem to be positioning, if not necessarily an end to the conflict, the idea that this rise that we've seen in energy prices would not have a lasting impact on economic activity. How do you view it?
Yeah, I mean, I think a couple of weeks ago when the conflict first started, definitely the market was trying to look through it, but it seems like this is going to last much longer than anticipated. Equities are pretty volatile here, but surprisingly not down that much. I actually would think they'd be down given the pass-through of energy prices into gasoline, how that leads through to consumption and spending. So I think markets have been surprisingly resilient. If this keeps going, I would expect more volatility.
Yeah, and to Powell's point, too, he sort of referenced this idea that all the talk of stagflation is probably a little bit overblown, basically saying that this is not the 1970s. In his words, that was a much more serious set of circumstances. I guess my question, though, and particularly for you, as someone who is very active in the rate space here, when you start to see yields go back up, and I think right now, certainly on the two-year yield, we're at the highest level since the war began. What is that telling you right now about the psychology of where traders think this market is going to go?
Yeah, well, the front end is pricing in the lack of cuts. The front end is saying with inflation here, there's just no way that they could drop rates unless energy prices come down meaningfully. And then the longer end, we're kind of in the middle of the trading range. The 10-year got down below 4%. Over the last couple of years, we've kind of seen 380 a couple times. We're at 420 right now. We've seen 450, so we're kind of in the middle of that trading range. It's hard to get overtly bullish on the long end. I think kind of that 2 to 5 year portion, now that it's repriced, looks interesting. It's hard to see the 2-year rise meaningfully unless we think inflation is going to stay high for many, many years. And for now, at least, if you look at break-even inflation rates, longer-term inflation expectations, call it 5-year inflation expectations, are still sub 3%. So it's kind of hard for the 2-year to break too much higher. I think you'll see more buying there than potentially the long end of the curve.
I thought it was interesting, the relative lack of dissent, particularly given some of the drama that we saw in the previous meetings. But I do want to address the elephant in the room and then with regards to Powell's tenure, because it seemed like part of the case for rate cuts, at least in the minds of the market, wasn't just the economic data itself, but also the idea that you were going to get Kevin Warsh to lead this Fed, and that, in theory, was going to push the Fed in a much more dovish direction. Does the idea, as Powell addressed today, that, well, he might have to delay his vacation plans for a little bit, does that change the calculus for how you think the Fed might actually tilt one way or the other?
Warsh comes in. I know he talks dovish, but he's got to fight the mandates of the Fed. He's got to fight inflation. He's got to keep employment strong. And if inflation's high, I just don't see how he could cut the 100 basis points some people are calling for. Just earlier this morning, you have some market participants saying, yeah, buy stocks because the Fed's going to cut. I mean, the market's not pricing that in, so I don't know where they're getting that information, but they're going to have to do what the data tells them to do. They're going to be very data dependent. And I think you just have to watch that data. And if the energy prices stay high, it's very hard to cut rates.
I do want to get your thoughts on something non-Fed related. And this really has to do with what's been going on, Ken, in the world of artificial intelligence. And, of course, the CapEx spend and now the big borrowing that we've seen in that space to fund that. We've already heard from some other fund managers out there saying that, at least for right now, particularly when it comes to software, they're not really willing to wade into that space right now. Are you comfortable with what you've been seeing with regards to the borrowing, overlaid with the idea of what may or may not actually be the return with regards to some of those AI investments?
Yeah, we're in the very early innings of AI capex spending, borrowing in the debt markets, and become a larger and larger percentage of many markets. Right now it's very small. There's a couple kind of off-balance sheet IG transactions that have gotten executed out there. There's some transactions being done in bank loans and private credit. CMBS market is lending to some data center owners. The ABS market's funding some data center infrastructure. But with time, it's only going to grow. I mean, if the market participants are right, and we're going to see multiple trillions of dollars of capex spending, it's going to become a meaningful part of the debt markets. And in debt markets, you don't have infinite upside like stocks. Like if you're going to own AI, I joke you might as well own the equities. Right now, the spread pickup for some of these transactions is minimal with a lot of uncertainty. So what we're doing at DoubleLine is we're avoiding as much of this exposure as we can until we get paid more for it. If we see a correction, maybe we'll wade into the waters. But for now, we think it's prudent to kind of limit our exposure in that market.
All right, Ken, have to leave it there. Always a pleasure. Ken Shinoda, portfolio manager over at DoubleLine Capital.